everyone! In today's video I'll explain how credit cards work in 6 simple concepts. If you're planning to get your first credit card, or if you already got a credit card and just want to refresh your basics on how credit cards work, keep watching this video. But before we jump right in, don't forget to subscribe to the channel and hit the like button. So credit cards allow you to spend, borrow money, and the key word here is spend. So credit cards are not made for cash withdrawals, for transferring money to a friend or family. Credit card providers don't want you to get the money out of the credit card and keep it under your mattress or save the money for some future purchase. What they want is for you to spend the money straight away. So the first concept of credit cards is credit cards are made for purchasing goods and services, not for you to take the money and do something with them later on. And that's why the fees for transferring the money to your family or friends or anyone in fact, and the fees for cash withdrawals are so high and so much higher than just using the credit card to buy something straight away. The second concept of credit cards is credit limit. Credit limit is quite a simple concept, it's the maximum amount of money you can borrow. And credit limit largely depends on your past credit history, on how good you've been with borrowing money, how responsible you are with your debt and managing your debt, on your credit utilization rate. So credit utilization rate is the amount of money you're borrowing divided by the total amount of credit available to you. So based on all these factors, credit card providers determine what's your credit limit, and it can either increase or decrease in the future. So if you've been very good with your payments, if you never missed a payment, if you're maybe paying your balance every month in full, being very responsible with your debt, having low credit utilization rate, then credit card providers can allow you to increase your credit limit, or you can request to increase your credit limit and then they'll consider it based on your circumstances. You can also ask to decrease your limit, but this is more of a measure of self-control. So if you're thinking you're spending too much borrowed money, so if you have very high balance on your credit cards and you're thinking you're not being responsible and you almost need some help from outside to help you manage your money and your finances, you can request decrease in the credit limit so that you're not tempted to spend more money than you actually have. So normally, to start with, credit card providers will give you very low credit limit because you haven't proven trustworthy yet. They don't know that you will be good with your payments, that you're going to be responsible with your debt. They don't know that you ever have a debt, so you actually know how to manage it. So they're actually being very cautious of borrowing you large amounts of money. The third concept of credit cards is monthly statement. So monthly statement is generated every month and it details your outstanding balance, all your transactions, whatever you deposited into your account and out of your account, your fees, your interest, basically everything you need to know about your credit card activities. The most important piece of information here is your balance. So the balance is the total amount of money you owe, and that's essentially what you will need to pay by your due date if you don't want any interest to be incurred on your account. So if you don't want to pay interest for any of the money you borrow, you will need to pay your balance in full by the due date. It's crucial to actually not be lazy and have a scan through your monthly statement every single month. So if there is a transaction that you don't recognize, you'd want to contact your credit card provider to make sure you're covered for this transaction, or that you understand what this transaction is and that you actually made this transaction. Or if there is an annual fee that's actually higher than all of your transactions combined and is higher than your balance, you might reconsider actually getting another credit card because the annual fee is so high for this one. And there are plenty of credit cards without any annual fee, so it will be an actual deal breaker for you. Or if you made a withdrawal from a credit card and you thought there is no transaction fee associated with the cash withdrawal, or that the transaction fee is much lower than displays on your credit card statement, you're actually going to be conscious about this next time you make the cash withdrawal, or maybe you're not going to make any cash withdrawals on the credit cards at all. If there is an interest on your credit card statement that actually shouldn't be there because you have direct debit set up to pay off your full balance, you should be conscious of this. So for example, your direct debit needs to be adjusted, you need to contact the credit card provider to make sure the direct debit is actually being sent on time before your due date every single month. The amounts like £2-3 doesn't seem like a lot, so if you have interest and fees summing up to £5 or to £10 this month, it doesn't sound horrible, does it? But over time, over 5 years or even over a year, it will sum up to quite high amounts of money that you didn't actually spend. So it's just something you can control. It's not like you bought a TV and now you're in debt, but you enjoy your TV and you know what you bought for this money. It's something that you can control by adjusting your direct debit or by changing your credit card provider, by just taking some action that actually will result in you being more financially stable. So the next concept about credit cards is grace period, and grace period is the time between your credit card statement generation and your due date by when your balance needs to be paid off. And legally the grace period has to be at least 21 days. So if you don't pay your balance in full during this grace period, that means the interest will be incurred on your balance. So you actually now owe to the bank, to the credit card provider, even more than you borrowed. Trust me, you really want to pay your balance in full every single month, so there is no interest piling up on your credit card statement, and your debt is not growing and growing every single month. Credit cards have variable interest rates, which means they can fluctuate over time, and the average APR, mean annual percentage rate, is 16.65 according to the Federal Reserve. So if your balance is £1,000 and you have an average APR of 16.65, what you need to do to calculate your monthly amount is divide 16.65 by 12, which would give us 1.39%. So you'd need to pay 1.39% monthly, which is about $14 that you need to pay every single month just for your money actually being in debt. So you still owe this 1,000 initial pounds, and then it will keep on adding up $14 every single month. So that's what called debt spiral, is when your interest keeps on piling up on your balances and keeps on increasing, and even if you're on top of your minimum payments, this interest still doesn't allow you to actually be debt free and to live the life of your dreams. And this $14 interest is actually based on average APR of 16.65, and chances are, if you're just starting your financial journey, if you recently got your first credit card, you're probably gonna have a much higher APR. Also, interestingly, if you make a payment between two grace periods, so if your grace period is 21 days, which is quite a typical one, then there is a period of about 5-7 days when it's not any of the grace period. So the grace period for the previous statement is already finished and the new statement hasn't been generated yet. So if you pay some amount within this time between two grace periods, it actually doesn't count toward any of your monthly statements. So you might mistakenly think, oh, I already paid the minimum amount this month, but if you actually paid this amount between grace periods, no, you didn't. So you'd still need to pay at least the minimum amount. And this brings us to the fifth concept of the credit cards, which is missed payments. Missed payments is not just if you didn't pay any amount of your balance every single month, it's actually if you didn't pay the minimum amount. So your minimum amount will be defined on your credit card statement. So if you pay £30 and you think, no, I'm fine for this month, I paid the minimum amount, I'm not gonna have a missed payment, but you actually look at your credit card statement and the minimum amount is £35, you're still gonna have this missed payment on your account. And trust me, you don't wanna have any missed payments for two major reasons. The first reason is a lot of credit card providers can incur credit card late payment fees. So that means if you miss a payment, or if you miss several payments in a row, then you'll be charged by the credit card provider essentially. So your debt will be growing and growing just because you don't even make an attempt to pay it off. And the second reason you don't want any missed credit card payments is it decreases your credit score significantly. So you might think currently you don't want any mortgage or any car loan anytime soon, so you don't really care about your credit history at all, but chances are at some point in the future you might want one of those things, and you don't want this 1, 2 or 5 missed payments limit the amount of money you can borrow in the future if you do need to borrow them at some point. Lastly, credit cards can protect you from fraud and allow you to earn extra money. So these ones are not very expected by most customers. With credit cards, all the purchases over £100 and under £30,000 are actually protected by Section 75 of Consumer Credit Act. The note here that this Credit Act is only active in the UK, so there isn't any equivalent in the US. Some credit cards offer some protection, but it's not as good as Section 75, unfortunately. The key moment of Section 75 is you're actually protected for the whole purchase price and not for the amount of money that you paid with your credit card. For example, if the amount of money that you paid for a purchase is £10,000 and you paid £5 with your credit card, you're actually protected for the whole £10,000 by this Section 75, because the credit card provider is now liable for the whole amount of the purchase along with retailer. It's very easy to forget about this important act, but in fact, this is the reason most people actually get their credit cards. You don't get this kind of protection from fraud or from any other financial casualties with your debit card. If you booked a holiday, for example, and your holiday provider goes bankrupt for some reason, like a lot of them did during COVID, but if you booked it with your credit card, you can now get a refund from your credit card provider and then let the credit card provider deal with getting any refunds or any money from your holiday provider. So it does give you a lot of protection. In addition, you can also earn money on your credit cards, which is something you don't expect to hear since the interest rates on the credit cards are crazy high. But if you actually make a good use of rewards, you can earn quite a bit of money. So rewards can be something like cashbacks, points, or miles. So if you travel a lot, Avios credit cards would give you Avios points, which you can then spend to actually book your holiday. So you can spend them on flights, or you can just opt in for normal cashback rewards, so you just get money back by making certain types of purchases. So here I gave you 6 main concepts, 6 main principles how credit cards work, and hopefully this video has been useful for you. If it was, please hit the like button down below and check out my latest video on how to use ChatGPT to beat the stock market.